Okay, folks. Well, listen, thank you for joining me today here Wednesday, August 12th to chat a little bit about what's been going on in not only the markets and the economy. We skipped July. Obviously a lot of folks were out of town and they still continue to be so for the last couple weeks here of summer, but there will be a replay of this for those individuals that have missed out. Um, and then the only other housekeeping item that I have on my list is if you have some questions along the way today, as we've done in previous sessions, please feel free to just jot them down in the Q&A button or section. It's usually at the bottom of your screen. Feel free to type away. I do have a couple of questions that people have emailed me, so I will try and answer those either kind of throughout the session or at the end. The goal today is to chat for roughly 30 to 40 minutes, depending on how many questions I get. Really, again, it's going to be an update of a market and economic update, chat a little bit about, the policy puzzle, and then also just, what we're thinking about as we navigate some of this uncertainty, along with some of the good fundamental data that we've been getting here in the last couple of weeks. Okay. So obviously, biggest thing right now is this ongoing uncertainty in the Middle East. Okay. And this is significantly impacting or has been impacting economic data, markets, and so on. And it's about as clear as mud. We're probably no closer to an agreement today than what we were, 5, 6 months ago, despite the optimism that continues to come out from the US administration. Things continue to stay in a very neutral state. So jumping into just the data from from economic point of view, and before I get into some of the slides here, I think it's really important. I've been talking about this for a number of months now, but really what we have in today's marketplace is we have two types of markets. We have one that's headline driven, okay, and then we have one that's data driven or fundamentally driven. And what we're seeing on the event side, one with the headlines, is obviously we're seeing a lot of this unrest, a lot of these disturbing headlines that can affect the markets the day after or the day of when it comes out. And it's nothing new. We've seen this last year from when the U.S. administration changed, when Trump took office. We went through that whole trade and tariff situation early in 2025. And it's been ongoing. And I think what's happened a little bit on the event driven is it's getting a little bit tiresome, and we're not seeing as much volatility come out from some of those headlines as much as we did in the past. But I still think that's an ongoing issue. And the second kind of part of the market we have is this fundamentally driven or data driven type market, where you go back to the economic data like inflation numbers, earnings numbers, and so on. And I'm getting people saying, hey, despite all the noise, why are the markets doing well? Well, it's because those fundamentals are healthier than what people realize, because those don't make the headlines. The things that make the headlines are the disturbing pieces. So if we look at Canada to start, and I'll move into the US, which really drives global markets, from a GDP point of view, we've actually had a really healthy rebound in Q2 of this year. So as you can see, midway through 2025, we actually had 3 of the 4 previous quarters of negative GDP growth. And generally speaking, when we have 2 negative periods of GDP growth back to back, that's generally leads us into a recession. That's the definition of it. Okay. Well, if we go back just as recently as just a couple months ago, the most recent data is that we've had a really healthy rebound on our GDP growth. So again, here's the fundamental piece of, hey, why are the markets doing fairly well? Now, when we move into the U.S. side of things, and again, they tend to be kind of commingled with what's happening in Canada as well. But when we look at the general market, probably 2025, 4, 3, kind of those couple of years previous, a lot of the market growth stemmed from the Mega 7. So that would have been things like Apple and Amazon, Meta, and NVIDIA, and so on. Well, what we're seeing today is we're seeing a much broader market breadth of companies that are doing well. And so when you're actually looking at, say, the Magnificent Seven, what you see there on the left-hand side, which is right here, we can actually see the overall contribution to the S&P 500 has actually been a little bit negative, okay? Whereas when you go actually from left to right, you're starting to see U.S. banks are outperforming. equal weight S&P is more broadly outperforming, which means all those companies outside of those mega seven companies are actually doing quite well. And that's been a significant change probably in the last 12 months or so, where we're seeing other parts of the market pick up. And I wrote about this recently about AI and the spending that these big companies are doing, these mega seven companies, what they're doing. And what we're seeing is some of the earnings that we're seeing reported today is a lot of those ancillary type companies are benefiting from a lot of this cap spend that these big companies are doing. So again, these companies are learning how to make AI or incorporate it into their businesses and actually become more streamlined and profitable because they're becoming more efficient. And we're seeing that reflected in the markets. So if we look at earnings season, so the most recent earnings season, if we go back, I've been talking about earnings season now for the last 3 quarters. In the US, they've been getting stronger each and every quarter season. And you think, hey, they're going to slow down at some point. But what's happened actually, if you look at this year or this quarter, if you look at the S&P 500 earnings as an average, you can see almost 85%, almost 90% have either met or exceeded their earnings projections. And again, it means they're profitable. And there's a lot of reasons why. But for the first time in a couple quarters, again, the forward-looking growth that these companies are coming out with are actually positive. Whereas, maybe if we go back to late last year, maybe even early into last year, a lot of these big companies, not just the mega sevens, but big companies on the S&P 500, they were reluctant to give their opinion or guidance on how they felt their profits were going to be moving forward, because there was just so much uncertainty with the whole trade and tariff related policies that were coming out. So, and again, when we look forward, we're at 2026, but when we look at 2027, 2028, there is still projected growth within the earnings per share. So what they're saying is, hey, we still think these companies will continue to remain profitable on a go-forward basis, not quite at the same pace as what we've seen in the past. And so when you look at projected year over year, 2026 is actually, pretty healthy in relation to 2025. And we saw that from 2025 to 2024. But now when we look at year over year growth, 2027, 2028, we're seeing still upward growth, but just at a slower pace. So that's still very positive for the markets and for these companies that will continue to report on a go-forward basis. Now, what about U.S. stock valuations? We've been getting some questions where people have said, hey, should I be getting out of U.S. companies? Right? Should I actually be rotating somewhere else? And my answer, and I said this a few weeks ago in a commentary, is we still believe U.S. companies have a place in portfolios. They're some of the largest in the world. They're leading this, kind of AI charge, this innovative wave that we're seeing, either in robotics, AI, and so on. And what's happening is we're seeing efficiencies that are actually trickling down to profitability. So when we actually look at U.S. equities in terms of valuation versus global valuations, we've actually seen this compression over the last, maybe 12 to 18 months. And this is just another indicator that we lead to and say, hey, U.S. equities not only are big and leading somewhat of the charge, but there's some good economic pieces of it that we see that, validates why we believe this. Okay. Now, I'm not saying that you should only be in Canada or global or what have you. I still do believe a more diversified approach is the right way to do it. So we have some global investments and maybe some international investments. We have U.S. investments, and then we also own Canada. And the reason we do that, obviously, is given this situation with geopolitical risks and given the situation with trade and tariffs and so on, I think broadening our client portfolios on a go-forward basis, provide a much more reasonable expectation to do well and minimize risk on the downside. And we're seeing that this year. Okay. Now, another economic indicator, again, not event-driven, but economic indicator, and I've talked about this this year, since probably middle of the year, is this manufacturing index, okay, this PMI. And what I talked about, I think it was back here when I was chatting about it, that was, we were seeing it at a low, and we had started to see the trend upwards. Well, this is generally an indication that, hey, the economy is getting on more sound footing. And since I started talking about it, we can really see it's really picked up. And the most recent data here in July was the strongest reading in 4 years. So again, generally when it's above 50, we're kind of in that growth stage. And we can really see over periods of time, if we go over it since 1990, what is that, 36 years, it rarely gets much higher than 60. Okay. But so we're trending above this 50 line. And again, we're marching towards where it's been, in years past where we've seen these really robust markets. Now let's trickle down to the consumer spending. So we've talked about it from a macro level. Let's look at the micro level and what that means in the markets. And again, when you look at whether it's the Canadian market or the US market, GDP growth, we're very consumer focused. The economies depend on the consumer, especially in the US. And so what we've seen in the most recent, kind of quarterly numbers is when you see a big uptick in comparison to previous quarters of consumer spending in relation to how it's affected GDP growth. We anticipate that to continue. And the reason why this is happening, again, good refund checks, if rates are staying where they are now and if cost of living comes down a little bit, people are going to have more dollars in the pocket. I will talk about that latter piece separately. But overall, in general, like I said, consumer spending is definitely on the rise, which is actually positive, again, from a micro level on the economic side. And then the last piece that I'll talk about before moving into policies is just the consumer confidence. So it has bounced around. And again, we've seen that, in 2022, when we had high inflation numbers, and consumer confidence wasn't very high. Inflation was, running at 7, 8, 9%. People were reluctant to spend, hit a low. And then we saw that rebound up to 2024 until we started hitting these tariff and trade related issues. And then we saw inflation creep up again. Consumer confidence has actually dropped to a low that we haven't quite seen since 2024, but we are seeing a rebound. We're starting to see it hit a bottom and start to pick up. And what's really interesting is when you look at the periods, you can go back over the last 50 odd years, these periods where consumer confidence have hit lows, the S&P 500 thereafter had significant rallies. So we've seen that again in 2022. We've seen this bump up, and then we've seen it fall again, largely because of these policies out of the U.S., but we're starting to see it bottom out and pick up again. So this is yet another indicator where we look and say, hey, does that mean the S&P 500 perhaps is going to go on this run where we're going to get some strong growth again? And my guess, likely, if things kind of stay status quo, we'll likely see this continue. The biggest headwinds is if there's some uncertainty out of the U.S. that significantly changes the landscape or the environment on a go-forward basis. Okay. So let's look at that. Let's unpack the inflation data. Now, this this is one day out of date because the U.S. Just announced their inflation data this morning. But generally speaking, we can actually see the U.S. Inflation, obviously peaked in 2022. It's slowly been coming down both in the U.S. and Canada. But unfortunately, given these trade-related and tariff policies, we've seen it actually creep up. And then when you couple that with the Middle East conflict, obviously the biggest driver right now is the price of oil, which, is on the rise again, given the uncertainty of what's happening in the Strait of Hormuz. So we're seeing inflation tick up, and again, much lower than what it has been. But the U.S., their target is 2%, and it's still sitting at roughly 3.5%. So challenge for them is, generally speaking, when inflation numbers are lower, it gives the U.S. Fed opportunity to cut rates. Right now, we thought coming into 2026 we'd see a couple rate cuts, while the street, the analysts right now, they think that the likelihood for a rate hike in the U.S. probably stands pretty much at a coin flip, 50-50, on a go-forward basis for the balance of the year. So if inflation stays where it is today, I wouldn't anticipate significant changes on their interest rate policy for the time being. In Canada, obviously, the Bank of Canada have cut much more consistently over the last 18 months. They haven't done it now in the last number of months, but they got down to a point that was much lower than what the U.S. was. And we've seen that just in their policy. They're just maintaining kind of status quo for the time being. Now, the other piece of the economic data that we looked at, so I just talked about inflation being kind of bad for U.S. policy. Jobs report it's bad news as well, but bad news is kind of good news because with a deteriorating job market in the US, one of the reasons the markets responded somewhat favorable to this is because generally speaking, with declining job numbers, we actually see interest rates decline as well. So on one hand, we're getting this negative news leads into potential rate declines or decreases, but then we see sticky inflation, and the U.S. Fed is really trying to balance two sides of it. So, again, from our perspective, we would anticipate no further rate cuts for the balance of the year unless something significantly changes. And it wouldn't surprise us if we see a rate hike if they can't get some of the inflation numbers under control in the U.S. So the longer this conflict goes on, the longer sticky inflation sticks around. And this is the kind of the last piece before we move in. How do we navigate, all of this data? So this is just going back to, Bank of Canada and U.S. funds, or U.S. Fed, from a interest rate policy. Again, in Canada, you can see it's fairly status quo, but if anything, it might increase a little bit, over the next 12 to 18 months, potentially. On the U.S. side, again, 3 months ago, they anticipated rate cuts. Okay, you see that with this dotted kind of gray line. Well, when you look at their current expectations, or even as much as 1 month ago, they actually anticipate rate hikes before it levels out and starts to come down again. And that makes sense. So long as oil stays high and these trade policies, tariff rates, and so on stick around, I would anticipate inflation to hover, around 3 to 4%. I don't see it coming down anytime soon, just given the fact of what's happening in our day-to-day lives. And I've used this example before. If you go to the grocery store, it feels like every time you walk out, you have less in your bag than what you did the previous couple of months. So, this is still a real issue, just in the marketplace. So yes, I say consumer spending is picking up and consumer sentiment is, turning the corner, but inflation numbers are still out there. It's a real cost for, again, especially some of the middle class, the lower, where cash flow it has a significant impact on their day-to-day lives. All right, so let's shift gears. So I've talked a little bit about from an economic point of view. I talked about some of the things that are driving markets. And again, fundamentally, things are actually pretty good. Earnings season is really driving what we're seeing in the markets today. And in large part, just to summarize, things have been pretty positive out in the US and even in Canada here. Okay, so how do we go about navigating these markets? What have we done for our families? And this might seem like a refresher for some folks. I've been talking about it for quite some time, but, as time goes on, we tend to kind of forget about what that approach is. So, our long-term thinking is the value of having 6 asset classes versus 2 asset classes, the 6 versus 2 scenario. And what I mean by that is most Canadians, unfortunately, subscribe to just fixed income, okay, and equities or stocks. And they're either buying it individually or they're buying it, in different pools or ETFs or whatever, which is a combination of the two. Okay. So with private assets, most of the folks that have been working with us for a number of years have had very good experiences with private assets, private credit, private real estate, private infrastructure, and so on. And I will show some specific cases of that here near the end of this session. And so if you look at where private assets are today, it's an asset class. And yes, they're actually going through a period of just kind of status quo right now, given what's happened in the marketplace. But if anything, current valuations today make it stronger than at any point over the last decade. Okay. Now, when we're designing portfolios, we're trying to design portfolios in a way that performs in various markets. Okay. And over time, we want to build wealth on the upside, but also protect it when we're going through these periods of volatility. And we've done that on behalf of each of you on this call. Okay. Now, when you look at this traditional 60-40 kind of portfolio or balanced portfolio that generally uses 2 asset classes, stocks and bonds, versus one that uses a more defined or diversified investment strategy where not only are there stocks and maybe some bonds, but there's also these other asset classes to complement it. we've actually seen the latter, the one that actually has the broader kind of diversification, not only have lower risk, but also has stronger returns over time. Okay. And I'm going to give you some examples here. Okay. Now, again, on the upside, if you're 100% equities, that's always going to outperform everything. But for most folks that we deal with, they need some risk mitigation. And so we look at kind of a couple of different scenarios: COVID-19, rate shock, tariff volatility. I'm going to show you 3 other examples thereafter. Well, if we just look at the S&P 500 at each of these periods, February, over 2 months, S&P 500 fell 20%. Okay. The traditional kind of the 2 asset class portfolio fell roughly 15%. And in 2022, by the way, 2022 for most people, Canadians that have invested in 2 asset classes, I'm kind of jumping for a second, but in that year, fixed income fell 12 to 13% and equities were down 10 to 20%. So this 60-40 mix in a year where there was a lot of uncertainty in 2022 fell double digits, believe it or not. So here, when we're giving the example of the COVID, again, S&P down 20, the traditional 15, a diversified portfolio with multiple asset classes actually only dropped 8%. So less than half in the market. So when you actually look at from a $1 million portfolio as an example, this difference preserved the decline of $72,000. And what that means is when things picked up, okay, instead of having to make up from 7.5 or 7.2% down, get back up to where you were at, they were starting from a lower, from a higher amount. The recovery was much quicker. Okay. Now, if you look at 2022, I just mentioned that this is again January to September. I gave you annualized numbers. The same thing. S&P 500 was down almost 18%. Traditional was almost 17% because again that fixed income environment also dropped double digits. Well, this diversified portfolio only dropped roughly 8%, 7.7%. So in that case, again, on a roughly $1 million portfolio, $88,000 was basically preserved. It didn't drop the same. Okay. Now, tariff volatility, again, S&P 500 dropped quite quickly, roughly 7.5%. Traditional 60-45, and a diversified portfolio 2.5. So these are just examples where we say, hey, we want to participate on the upside based on your risk tolerance and what we're looking to achieve. But when we do go through periods of decline, we want to make sure that we're actually doing our best to protect that. And how do we do that? We take an approach that not every Canadian has access to, which is, not only be diversified, geographically, sector, but also by asset class. Okay. And we've actually seen in theory and in practice, the benefits of it. Okay. So let's just look at this. I'm going to throw 3 pieces and then wrap it up with a couple of additional slides. And then we're going to open it up for some questions. So if you do have some questions, now's the time to start to type away, guys. So here's another example. So again, this is just 2020 in a visual. So this one, I just gave you the overview. So this is really what it looked like when you actually compared those 3 different portfolios during that crash and how long it took for these portfolios to make it up again. So when you actually look we learned that behavior is a big indicator or influence of how Canadians invest. Okay. So we've learned over time, if people sleep better at night, they're less likely to make irrational decisions. Okay. So here's the COVID-19 crash, same ones as before. Okay. We can see that peak drawdown throughout the year was down roughly 10%, whereas the markets were down well over 20. Okay. By the time, every market made it back, okay, it actually took almost 7 months to do it. So if you actually look between start to finish 7 months, well, the folks that took a more diversified approach and likely made changes along the way as things got better, just had a much smoother experience overall. They didn't have these sleepless nights when there was a lot of uncertainty. Now, 2020 was a real interesting time where that decline was very short. As a matter of fact, we didn't have a ton of clients that reached out to us when markets dropped significantly over a short period of time. And I think part of that is if the decline was quick, the upside was quick. I don't think people had the opportunity, to really feel disturbed by it. Plus we were dealing with a humanitarian kind of crisis that we never faced before in our lifetime. If we go to the second one at the tariffs, again, this is even probably a better idea. At the beginning of the year, we can see the growth that we had in the markets. And then the peak drawdown, again, at the 2025, we can see equity markets fell significantly. So equity markets were, +2 down roughly 5%. Well, if we looked at, again, a more diversified approach was down less than 1% at any given time. And even after 5 months, this diversified approach was positive versus negative in these two other times. So the risk or the standard deviation on the downside, the volatility was much lower from a risk-adjusted point of view than it was just if you had equities or this kind of two security type investment strategy. And then again, we go back to the start of this year. Again, we can see quite a bit of volatility here with markets down quite sharply over, a 2 to 3 month period. Again, a more diversified approach using 6 asset classes had a very nominal decline. And this is what most people here have actually experienced. It's been very smooth. Like I said, the ups and downs have been much more gradual. Yet at the end of the day, we're getting to roughly the same result at the end of the day, but taking much less risk. Okay. Now you might say, "Hey, Wes, this is all fine and dandy. I get it, but I don't understand like the details of it." So let's give an example. Okay. So if we look at a Canadian fixed income kind of investment over the last 5 years, here's 2022. Okay. This is when we had high inflation, 2022, 23, 24. Well, for Canadians that are investing in fixed income, this is just the Canadian fixed income index. The total return with somebody that is using this in their portfolio has been a grand total of 1.4%. And that doesn't mean annualized, guys. That means that somebody that held this 5 years ago to today would have been at 1.4%, including any distribution. So they would have made 0.3% per year. Okay. Now, unfortunately, for a lot of investment professionals, they only have access to fixed income. Okay. Or fixed income investments that might be coupled with equities. Okay. They may not have access to these other asset classes for different reasons. Well, if we look at the asset class, and I'll give you the example of the Rockbridge private credit pool. Okay. Over the exact same 5-year time period. Okay. Now we're talking micro level. We're talking about a bond investment. We're talking about private credit. They're different. They are different. I agree with that, but they're all debt related. The return on this private pool was plus 31% over that 5-year stretch versus 1.4%. Okay. So if you have 30% or 40% in non-equity investments, this is why we've actually had much more consistent and predictable returns, is because not only are equities doing okay over the long run, but our more conservative pieces doing well too. Okay. Now we do believe in real estate and infrastructure as well. So the way most Canadians access real estate is through a REIT, which is a real estate investment trust or income trust. And what it is essentially is there are companies out there that are publicly traded that will buy a lot of properties across the country or maybe in Canada and the US, and they bundle them all together, and then they trade on the TSX as a bundle of real estate properties. But because of that, that stock gets influenced by interest rates, by investor sentiment, by global events, and so on. So in 2022, as an example, high interest rates, REITs didn't do very well. 2020, when we went through COVID and, there was a number of stocks that closed for the short term because, again, we had some uncertainty there at the beginning of the year. REITs fell 50%, even though those businesses, restaurants and so on, continue to get government support and still made money. Okay. But again, the outlook on these publicly traded real estate investments, again, fluctuated significantly. So when we look at it over a 5-year return, again, total return, meaning that these investments have paid investors money plus capital appreciation over 5 years in Canada, you would have actually yielded 8% based on the index, and in the US, roughly 13%. Okay. So over a 5-year period, that's roughly 1.5%, 1.6% in Canada, maybe 3.5%, 4%, 3.5% in maybe a little bit less in the US, probably 2.5%. Okay, and in real estate. And we know right now real estate is going through a real tough time. We know that residential real estate, I see it when I get my statement, my property assessment, everything is on the decline right now. Okay. Now, that being said, there are some things that are still doing quite well. They pay income. People aren't selling because their real estate is flat. That asset class is just going through a period of time where things have to work out before we see that next leg. And it's not unusual, guys. Like, this happens. Stocks, gold, digital currency like Bitcoin, equities, bonds, they all are cyclical. They go through these periods. And right now, real estate is this. Okay. Now, again, this is public. When we look at private, like I said, one of those other 3 to 4 asset classes, this is the private real estate portfolio, which also has infrastructure in it. Okay. And this has done roughly 38% over the last 5 years. So better than 7.5% per year. Okay. With very little volatility. You can see there hasn't been really any significant drawdowns. Reason why is these get priced on a monthly basis. This pool, like the Rockridge, has between 15 to 20 sub-advisors in there. And there's a specific due diligence process to add and subtract those managers. So when you see that one line item on a statement, that one line item is actually a combination of 15 to 20 investments. So again, how do you manage the risk within these other asset classes? Just like we do with the rest of the portfolio, it's diversified. So if you get any headwinds at one specific company, you can have anywhere between 15 to 20 that can help offset the risk. Okay. So I'm going to change gears a little bit. I'm just going to talk about equities, publicly traded equities. And I'm roughly at 30 minutes here, guys. So I'll wrap in about just over 5 minutes. So we have a due diligence process internal here at Oakwater, and then also as a firm with Harbourfront. Okay. And so for a number of folks that are on this call, you happen to have some equity pools, Jackson and Percy Harris, Jackson Park Global Equity and Percy Harris. And you have those in your portfolio today. Similar to the alternative pools, those managers within those pools, there could be anywhere between 5 to 10 underlying managers. Okay. Now, those are managers that we can just easily access on the street, like go across the street and get a TD manager or a Fidelity manager. These are managers that manage significant amounts of capital for institutional money managers that might be out of the UK, that might be out of the US, Boston, New York, and so on. Out of Canada, we can cherry pick some of the top one. But generally speaking, the portfolio managers within the pool are ones that we generally cannot access, directly on behalf of our clients. So what happens in those pools? Well, there's a very specific due diligence process. So as an example, it's multi-manager. Number one, diversification across styles, processes, and within regions. Okay. So there's active fundamental approaches, a quantitative tactical sleeves within there that are happening. Okay. What it also does is it reduces single manager risk. And the third one is a combined specialist expertise. One of the benefits, again, is this rigorous due diligence or oversight. These managers are on calls generally on a monthly basis with these sub-managers to figure out what's happening within their shop. And if they deviate or they don't feel they're keeping up with their expectations, they will fire them and replace them. And we've seen that happen a number of times. Okay. So what they do, again, on behalf of the due diligence, they do quarterly peer group rankings. They looked at how much they drift. So style drift. So, is anything happening outside of what their anticipated results are? And if they are getting away from kind of their style or what their expectation is, they can put them on a watch list and they can look at them a little bit more deeper to see if they need to be replacing them in the near future. Okay. They also look at risk-adjusted return metrics. Okay. The oversight due diligence, again, formal watch list process. It's also part of the Harbourfront Investment Committee. They do a review on a monthly basis. And again, there's rebalancing within that pool. So what we might get is somebody that says, hey, you know what? I don't see lots of things happening within my portfolio. Well, because there's not an activity in your portfolio, it doesn't mean things aren't happening in the portfolio. Okay. There's a number of things that happen behind the scenes besides just a trade. So as an example, I happen to have, me personally, I happen to have some dividends dividend producing investments in my portfolio. Well, over the last 2 years, I made maybe one or two changes because I've liked most of the things that I'm holding from a dividend perspective. And Canadian companies have actually done, or they've continued to do very well. So I'm not going to just do a trade to do a trade when things are not broken. Sometimes investors or individuals think the only way I know if things are happening in my account is if I see trades. And that is not true. We get hundreds of companies that report every quarter, and sometimes we look at what their new, what the new news is, what they're reporting, and we say, is this still something that we believe we should be owning on a long-term basis, short-term, and so on? And sometimes we have to just readjust expectation. So the fact that you don't sell something, it just means, you know what, we reevaluate it, and we still think we should own it. Okay. So if you look at a year to date, as of June 2026, Percy Harris was up 17.6%. Jackson Park was up at 12%. I know that doesn't mean a lot, but I can tell you as of the end of June, these have both outpaced equity markets. Okay. Now you might say, hey, as of the end of June, Wes, that's a little bit dated. We're now July and August. So I just thought I would show this here. Percy Harris again against the peer group. Before I get to the updated year to date. Against the peer group, we can see if that has done exceptionally well. Continuing again to outperform in the space. Jackson Park, same thing. Okay, has done extremely well. And then if we look year to date, guys, this is where they are year to date total return because they do have distributions. Percy Harris has posted just under 20%. Again, outperforming equity markets. Jackson Park is more so in line at roughly 16%. These are all net of fees, by the way. So again, we're getting not only good diversification, we're getting a strict due diligence process where, companies are being hired and fired based on their performance, based on what the expectations are. But their overall returns, again, from a risk point of view and ongoing upside has been phenomenal. So for a lot of folks, you might own some of these as part of the public equity sleeve, and then we may own ETFs, individual stocks, and so on. But collectively, we take a similar approach where we're saying, hey, we want to buy good quality companies. We want to make sure they fit well together. And what's the overall risk of that portfolio? So when we do go through periods of uncertainty, we know with fairly reasonable expectation what that decline might be and does it meet within the criteria of our clients. Okay. Folks, that was my last slide. I'm going to actually just open it up for questions. Like I said, I do have a few here today. So I actually had somebody email me and they said, the global economy, we recognize North America, but what are your thoughts on the global economy? Is it going to last? And, generally speaking, we still think the global markets, so Europe and even China to a certain extent. I mean, there's a lot more risk, with kind of emerging markets, quote unquote. But, Europe's done very well. And clients own Europe, European kind of holdings here again through some of these pools that I just mentioned. We don't generally buy individual stocks when it comes to those markets because, again, those markets, they might be open when we're, not in the office and vice versa. So what we prefer to do is we tap into good quality, high quality managers that really understand that space, that might be flying there and researching companies and so on. And we'll access them through maybe an ETF or maybe a pool strategy. From time to time, we might own an individual stock, but it's typically a large cap stock that we feel is a good hold. But generally speaking, again, we tend to access some of these global economies, again, just differently rather than individual stock. Okay. Somebody asked you the consumer sentiment slide. That consumer sentiment slide is out of the US. So I show the consumer sentiment just in general about, hey, what happens generally with S&P 500 when consumer confidence is at the level that it's at. And the slide before that was US consumer confidence that's on the rise. So two of the reasons why we think the US is still poised for some growth. So, okay. Somebody asked me about changes in the portfolio. I just addressed that. And then the last one is just, somebody had just asked again about trade and tariff policies, and I'll kind of couple this together. It's kind of my last question that I had emailed in. If anybody else has a question, please put it in before we wrap. But biggest thing, obviously, is this ongoing, Canadian, U.S., Mexico agreement, CUSMA. What are our thoughts on it? They didn't renegotiate it or re-up it. Basically, it's just sitting open right now. No real specific changes to it. We don't anticipate the US or Trump to actually enter into anything kind of long term. We know there's some changes that are going to happen next week in terms of just tariffs. But when you look at the overall tariff rates within Canada, we're still generally one of the lowest ones globally. But again, it goes back to my comment about headline driven or event driven versus fundamentally driven. So headline driven, when it's announced in the media, we can get a little bit worked up because we don't understand, the full realm of what's happening. So again, we just think it's kind of status quo. We knew this was coming, early in the year. Markets hadn't really moved too much, despite the fact there's been no progress on it. But we are closely watching it because we're trying to see, what may or may not occur and how is it going to impact, our Canadian companies in the market. Questions here on financials and utilities. So financials, we still think, Canadian financials, we still think are going to continue to do well. They are reaching all-time highs. I mean, I'm in the same boat as most folks here that own them, but I like them. They still pay, 2, 3, 4% in dividends. They're well-funded. We think the whole shift in AI and how it's being integrated into businesses, we think the financial sector could be one of the biggest benefactors because, as you know, financial companies like our banks, they're all about profitability. So we're seeing it in our company on the back end with our back office, which is National Bank. Things are becoming more streamlined from a technical point of view. So all of that leads into higher profits and consistent profits. With respect to utilities, I still like them. I still own them. I think long term they're good, especially if there's uncertainty. I used an example the other day about Fortis. Regardless of how bad markets get, how bad the economy gets, and so on, I'm pretty sure almost everybody on this call is going to continue to pay the utility bill, right? Because we all want to heat our homes. So I'm in the same boat. So I just think, hey, if I can own a stock that consistently pays me a decent dividend and I get some upside that I know is going to, hopefully remain somewhat profitable over the long run, I think it's a good hold. Where we might run into some challenges is obviously depending on what happens in the interest rate environment. But I definitely concern it too much right now. And then just back to the comment about financial, because I'm really talking about banks, but I think financials, even on the when you think financials as a whole, things like insurance companies, which would also be categorized as a financial. Canada, we really have like 3 to 4 major insurance companies. They continue to knock out profits. The last quarter was a little weaker with some of them, but again, I still like them from a dividend point of view. I still like them from a growth point of view. Again, I think AI is really going to benefit them as well because they have a lot of areas in their businesses that they can streamline by using programs versus people, unfortunately. But from an investment point of view, like I said, I still like the broad Canadian financial market. So, folks, that I'm going to wrap here. Like I said, it's roughly 1:45. I was close to what my target was. There will be a replay that will come out from this. If any of you have questions that maybe pop up after this or what have you, feel free to email us. Email myself. I'll try and get back to you. Like I said, moving forward, just if I could summarize it, as we head down the final stretch of summer, I don't think there's going to be much changes. And as we tend to get into the fall, obviously people get back into the swing of things. September, October, we'll likely see maybe new economic data that generally comes out. And then the back half of the year tends to be some of the strongest in the markets. And then when we're talking about tax planning, things that you should be doing for the end of the year considerations and so on. But like I said, we will be continuing to do these throughout the year. But in the meantime, if you have questions, don't hesitate to reach out. Okay. All right, guys, enjoy the rest of the summer. Thanks for joining us. We'll talk to you soon. Take care. Bye now.